We talk a lot about how to set your loan amounts so that the lender, you, will never lose principal. But to be honest, it really is a compromise, a negotiation between the lender and the borrower to create a win-win deal. We're going to tell you all about it right now.
Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey, everybody. Thanks for checking out the show. If you haven't done so already, go take a look at lendersoftware.com, Lendr software.com. Lender has quickly become the number one loan servicing and loan management software inside the Mastermind. Go check out that site, lendrsoftware.com. Talk to the founder, Bryce. Let him know you were referred by our podcast, and they'll give you a discount on setup. All right. So we talk a lot about this, and we're going to come at it from a bit of a different angle because, you do have a customer, a client. It's the borrower, right? And it's definitely incredibly important, the most important, to protect your principal, have the right loan amount, leverage, but it really is a compromise. So starting off with the two extremes. One extreme is completely in the lender's favor, which is, oh, why don't you put down 50% in cash and I'll charge you 15% in 5 points. Sounds great, right? Not realistic, not going to happen. And then in the other extreme, and we do know some lenders who come into the Mastermind who are guilty of this, and they do whatever the borrower says. I'll borrow from you, but the terms have to be this. You have to finance 100% of it. All fees and interest are not going to be made month to month. It's all going to be rolled into the back of the loan. And once we sell the property and pay off the loan, that's when you get to make $1. That's the opposite extreme. Neither one is correct. And so we're going to talk about how to arrive at a compromise in the middle.
Yeah, and another example of this that we've joked about in the past is being a hard money lender, especially on the front lines, is hard. It's challenging because you got to wear your sales hat and you also got to wear your banker's hat, and you can't be too much of each. Now, a good salesperson, a good front end hard money lender can play both sides and be strategic. And I feel like we do that strategically. We've got a lot, almost 20 years of experience of doing that. But I need to be salesy on the front end to help the client and to show like, hey, I'm looking out for your best interest and I want to get you the best loan terms and the best setup based on your situation. But on the back end, I have to wear a banker's hat and an underwriter's hat to make sure that the loan performs. When we were starting out in this business, there wasn't a lot of liquidity in this space. And our competition, they were just bankers. It was like, I have the money, I make the rules. And in essence, you can't portray that to the borrower on the front end. But like you said, Chris, there's too many lenders out there that are not lending at the right leverage. They're lending out way too cheap. They don't need to do that. And they're just, in essence, doing deals to do deals, and their bottom line profits are probably not all that and great. And then they come to us at some point because they're like, I'm in too deep. I've got a lot of money deployed and I'm scared. The leverage is too high. The borrowers control the situation. And they don't realize until it's too late. Like you shouldn't ever lose principal in this business. Like you just shouldn't. If you're writing loans at the right numbers and your LTVs are good, not only on the after repair LTV, but your day one at LTV. If you're lending 100% financing and you're like, oh, well, I'm lending 100% financing, but I'm really, well, here's another quick tangent. You ask somebody, hey, what are your LTVs? Oh, I'm lending at, 70 LTV, 65 LTV, 75 LTV. But they forget to say that that's the after repair value LTV. That's not the day one LTV. So that's great. If let's say you lend somebody $100,000 for purchase money, $50,000 for construction, it's worth $200,000, right? So it's a 75 LTV. If that property is completely done, perfectly staged on the market for 200, you're safe. Good news. You're good. But you have so much risk between day one and day 90 or day 120 until it gets to that point. Because guess what? You lent them $100,000 up front and they don't have any payments. Let's say all the payments are getting rolled in or something and, it's accruing in the wrong direction. What happens if they don't start the work? What happens if something happens to them? What happens if they have 5 projects going and they realize that, hey, I don't have time for this? What happens if their contractor steals from them? What happens if something happens and their construction's over budget and they walk away from that thing? Forget you missing out on interest. You're not getting your principal back. There's a big point of your principal that you're going to lose. the first lender should never jeopardize anything on that end. It should be they should have the least amount of risk in this transaction. So we're going to talk about ways to prevent that, and we're going to talk about ways to make this a win-win scenario, because there's two sides to this. There's, in a perfect world, what the borrower wants, and in a perfect world, what you want as a lender. And we got to go through and mold this so it's still a win-win for both parties.
Yeah, let's go through another one or two examples of, not the right way to do it. So, one story about a lender that came into the mastermind. We were at an inner circle meeting, and they had started lending during that year. I want to say it was 2024. They had started lending during like the first quarter of that year. They came to our November meeting. They took too much guidance from local borrowers in their market who said that they needed to take their fees and interest at the time of payoff. It's not uncommon. Some lenders are going to be listening to this, watching this, and saying, no, of course not. I mean, I get fees paid at closing and I get interest paid monthly, which is how it should be. But there are many lenders listening to this right now that said, oh, yeah, I mean, I thought that was normal, just to get paid when the loan pays off. It's not. It's not ideal. No lenders do that in all of real estate lending, unless they've taken some guidance from the borrower that maybe they shouldn't have. And so this particular lender that came into the mastermind group, they had already funded a bunch of loans. Like they had maybe 7 or 8 million outstanding all in 1 year, given out to borrowers, flippers mainly, in their local market. And so they come into the November meeting for the first time, meet everybody. They get up to do their mastermind, their 30-minute presentation about their business and to get feedback from the group. And we were like, wait a minute. You started lending 6 months ago or so. You haven't gotten paid yet. And you put out a bunch of money. It's not easy to put out $7 or $8 million in this niche in 1 year. Like a lot of our offices like really fight and struggle to do that. And wait, you haven't gotten paid? Something's off here. Something's really wrong. And that was the first thing that we, the group, fixed for this lending company. And they come back the next meeting. They're like, oh God, this is so much better. We get our points paid at closing. They pay interest monthly. You can charge what you want. Like if you're getting, you know, 12.99 and 3, like we do great. If it's a little bit less, then okay, no problem. But you should be getting paid. It is commonplace. It is customary in the lending business to get your origination fees at the time of origination. That's why they're called that. And monthly payments, I mean, look at it across real estate lending, residential, commercial, all kinds of stuff. Your homeowner mortgage, like monthly payments are the norm. Accruing payments and increasing that balance owed throughout the term of the loan is not the way real estate lending works.
Yeah, it's not even that. I mean, you're right. It's not how it works, but it's also cash flow management. Like if you have a staff or if you have a salesperson, how are you going to pay a salesperson? You're going to either front load it or you're going to wait till the back end before they get paid based on deal performance. You're never going to be able to scale or do anything that way. It doesn't work. It's got to be paid kind of on the front end. And also, you don't even know the health of your portfolio if borrowers aren't making monthly payments, because you have no idea if they're running into problems or not. Yeah, I get it if you're doing a construction holdback on it, that you can have a trigger in place knowing that they're drawing from their construction funds. But like we know in real time what borrowers are struggling and which borrowers aren't struggling based on who's making payments and who's not making payments. Very, very simply. Like you have to have that in place to track. And the rebut that a lot of lenders that we know that are kind of fallen into this trap say is like, well, I'm scared that I'm not going to do any business, or I'm going to lose my best borrowers. And that might be the case. And listen, you might have to take a step back to take 2 steps forward, but you obviously recognize the problem and you're nervous about this. So something's got to change, right? Listen, if we gave everybody 100% financing, no payments, cheap terms, you don't think that would be super easy to do unlimited deals forever? It'd be super easy. You do a deal for somebody, they tell their friends, they do every freaking deal with you. But that doesn't mean that they're safe deals. And you're not going to learn that lesson until you get bitten. And by that time, it's going to be too late, because you're not just losing, potential interest. You are losing principal if a deal like that ends up defaulting or if something happens. And it's a matter of time until it does happen. So if that's the business model you're trying to follow, best of luck to you and keep going. But it's going to be a challenge. And I will tell you from experience, from us doing over 4,000 loans over the last 19 years, is that good deals still default. Low LTV loans still default. A plus borrowers still default. Things happen that still make projects default. And you don't want to be responsible for losing capital. You don't want to be responsible for losing your investors' capital. Not a fun feeling to have. So work forward to do good deals. Let's talk about a little bit, a few things. And this also doesn't mean like you're doing bad borrower deals. You can like good borrowers will still accept, you know, 20% down, 30%, 13 and 3 terms. We do them every month. I know lots of lenders in different markets that do it every month. Do you have to go market and find deals and grind to create opportunities? Absolutely. But that being said, they're out there. Just because, the few borrowers that in your local community, are demanding high leverage, low fees, let them go to an institutional back lender. And guess what? Some of those lenders might not even be around forever, right? Because you do bad loans over time, bad things happen. So work towards doing good deals over and over and over. So let's talk about some scripting related to compromising on a win-win loan amount, because I feel like we've gotten pretty good at this over the years, and our business partners that run our other offices do as well. So let's use an example. Let's say a borrower's buying a property for $100,000 and it needs 50 grand in work, right? We'll go through the scenario with them. We'll probably do some sort of price anchor. So we'll say scripting something like that. Be like, okay, okay, so you're buying it for 100, needs 50 grand to work, 150 all in. It's worth, you say it's worth like 200, approximately what are you looking for loan amount wise? And they'll come back and say, well, I was looking for the most, the most I can. Maybe the whole 150, maybe 140. Be like, hey, if I could give you like $100,000 loan with a $50,000 holdback, is that something that you can make work? Right now, keep in mind that's 50 towards purchase, 50 towards the construction. So that's 50,000 down payment plus closing costs. That's a lot of money. For a $100,000 loan, they're going to need 60 grand on a $100,000 loan, give or take. Right. So typically, I'll do it as a script where it's just like, hey, just throwing it out there. Is this something you can make work? Now, typically, what they'll say is, yeah, I was hoping for a little bit higher than that. Okay, well, approximately what? Well, I really was looking for 100% financing. And the rebut is going to be, like, unfortunately, I can't do 100% financing. Like, I can't. Like, you are going to have to put some money into this deal. If I came up a little bit more, is that something you can make work? And in essence, you try to kind of go back and forth until you compromise into a number. Now, if they're like 100% or nothing, then it's not going to work, right? You can't make a deal work. You got to understand that you can't make every single deal work. Every single real estate investor that applies to work with you, or every single real estate investor that comes to you that needs a deal or that needs funding, you can't do. This is a tricky business. This is like one of the only businesses that people come to you and want to give you money and want to, buy your service. And you're like, nope, that's not going to work. And you got to be disciplined for that to happen. You got to say no to them that it doesn't work, even if they're very qualified. It's not going to work. It won't work for you unless they're willing to put, a big enough down payment. And if the numbers all make sense. I get it. Them having a good project's important. It's the most important. Collateral is the most important. But next is character and capacity and credit. All those things play a role. And having skin in the deal and having capital down and having the ability to execute has to happen as well. So in essence, you figure out and you compromise a win-win. And usually what happens if you're close enough into a deal that makes sense for both parties, you can usually win that deal. And the reason you can win that deal is because you can provide local service. They're talking to you directly. You can move quick. You're easy to work with. And you explain that to them and it works. Now, if you want them to bring in 60 and they only want to bring in 10 or 20, that's not going to work. If you want them to bring in 60 and they're like, hey, I can make this work at 40 or 45 or 50, now we're talking. Maybe there's opportunity there. And that's what I mean by win-win. And one last tip on that component, because I think this is really important, is make sure they understand you're local. You might come out to the property, your partner might come out to the property to look at the property. You want to help them. You're easy, you're fast. And also a really important one is tell them about um what's the best way to explain this? Not babysitting them or micromanage them on a project. Because what we'll usually say in an example like this is say, "Hey, listen, I know you want to bring 40 grand to the table. I can't get that low. I can get to 50. But that being said, at a $50,000 down payment, I'm not going to micromanage you. You asked me for, a $10,000 draw for a roof and to do some rough-ins, and you only spent 9 grand. I'm not going to nickel and dime you for $1,000. If you got the majority of it done, I'm going to give you a draw and I'm going to keep it moving, and it's going to be simple. If you go if you have experience with an institutional lender or a bank lender or someone that gives you hot super, super high leverage, they're gonna micromanage every part of the construction, draw schedule. You don't wanna be micromanaged. You don't wanna be babysat. I don't wanna babysit you. I just want you to put up a little bit more money, and then our loan is a little bit less risk, and your life is gonna be a lot easier, and we'll just keep it moving. It'll be a very simple process, and we can do these deals over and over and over. So that's kind of part of our scripting, which can usually get somebody to put up another 5 or 10% just because of that. And it's true. Like, I'd rather put a higher down payment into a deal if it's gonna be an easy transaction, they're not gonna micromanage me, than dealing with a bank that's gonna ask or an institutional lender that's gonna ask for a lot of stuff and micromanage the crap out of the construction process.
One of the when it comes to scripting and everything else, I was thinking about when you were talking is that we try our best to give all of our loan quotes verbally so that we can have a conversation, have an opportunity to sell what we're good at, right? We control our own funds, we move quickly, all that stuff that we talk about. And sometimes it's easy to get lazy, especially with broker business. Like I manage the lead flow for a list that we have that's focused on commercial and multifamily. And most of this stuff is brokers bringing us leads. And it's very easy. And, we quote conservatively on commercial, usually in the 50 loan to value, loan to cost range. I know that sometimes it comes off as like a go away quote, you know, like somebody brings us a deal, it's an acquisition, it's retail. It might even be outside of our market, which we do here and there on commercial. And I'll be like, yeah, okay, they're buying it for a million, we'll do 500K, 1299 and 3 by email to the broker, which is just lazy origination, not the right way to do it. It is a little tough to also brokers always come at you saying, "Oh yeah, here's the deal, here's the main points. We're looking for max leverage." Are they really looking for max leverage? Not necessarily. It's just what they're trained to ask, just what they're trained to say, because in their mind, that's doing the best job for the borrower. But it's not necessarily the case. And what I should do, and now I'm gonna, take my own advice on this. Next time one of these leads come in, I'm gonna be like, "All right, yeah, let's talk through it. Can you schedule a quick conference call with the borrower?" Right? Instead of just putting out like a 50 loan to cost, something they perceive as like a go away quote. And, I've done this too many times. Like I'm gonna take my own advice next time, set up a quick call with the borrower and the broker and be like, let's talk it through and see
Yeah.
what you really need to make the deal work. Like maybe it's not 50 loan to cost, maybe it's a little more. Maybe, I don't know, maybe it is that. But you just get the perception from the broker that they're looking for max leverage, and the broker might even be like, tell the borrower, yeah, they're HMB, they're not a good option on this one. They, quote it really low. When in actuality, it might work fine for the borrower. There's just that, that gatekeeper in between them. Um,
Yep.
and just have a conversation and try to get to that compromise. Try to get to that win-win. Like, what do you guys need to make this deal work? Especially if you have a time frame and you need private money that can move quickly and hit a closing date, whatever it might be, and try to find a win-win loan amount.
Yeah, but I mean, that process does work 100% of the time as long as the borrower can make that deal work in your scenario. Sometimes they can't, but it works. Like, that is the process that has to happen. It happened today. There was an out of state deal. It's in one of the states that we're willing to lend in, even though it's out of state at a lower LTV. And I talked to the borrower with the broker. The broker hit me up. Hey, we got a recent appraisal at 1.1. We can make this work at a 50 LTV, which is 550. I looked at the deal, didn't love it, abandoned or vacant restaurant. 50 LTV is good, don't get me wrong, but, like, there's still a lot of other things, and also, I don't wanna micromanage some of these projects in general, so if it's a funky outside the box one, even if it's really good collateral, really good borrower, like, there's unknowns that I don't want to do. It was a vacant restaurant. There is a roof that has to get replaced. There's some other stuff that money had to go towards to get it back up and occupant and occupied. So I had in my head about 300 grand. I was like, that's probably where we'll be at. Had a conversation with them. And I was like, hey, let's just talk to the borrower real quick. Let's just have a quick chat. I want to pick their brain a little bit to see what's up. So I got on the phone. We talked through it a little bit. And I was like, hey, listen, I was like, I don't think I'm going to be able to get to the 550 that you're requesting. Unfortunately, it's not going to be, it's just not going to be a good fit for us in this particular case. It's a property that's out of state. I think you might have better options elsewhere. We could lend, but it's probably going to be like half of that, if that could possibly work. And like, he was thankful because it was the way I perceived it. If I just emailed him or if I just called him and said, hey, 30 LTV, 50 LTV, whatever it is, it's like, go fucking pound sand. If I emailed this, he would have told me to pound sand. But I was like, hey, listen, honestly, like, I think this is a really good project. I think you probably have other options out there. We just not going to get to that 550. We're going to be a good bit lower, type of thing. And then of course he was like, oh, well, how much lower? I was like, I could probably get it at like 275, maybe 300. It's just outside our box. I don't know the area that well. This is just where we're comfortable with. Very, very nice. He's like, oh man, that's great. I appreciate it. And then in essence, it ended as I don't know if that's going to accomplish everything he needs, but if it does, it's, maybe it works. And I know what will happen. He's going to come back and, probably be like, hey, I can't make that work, but I can make this work. And if it's like 350, we'll probably do it. If it's 400, 450, we probably won't do it and call it a day. And that's what's going to happen. And we're not going to lose the deal because a bad sales technique. We're not going to lose the deal because, we'll lose the deal based on it just might not be able to fit his needs. And that's okay. I'm comfortable with that. If that's the case. I also know that small balance commercial properties that are vacant, borrowers don't have a lot of options. And there's risk in those deals. And the biggest risk is the exit strategy. So I have to take that, we have to take that in consideration of this is why I want to be sub 50 LTV, because there's a good chance that this person's not going to be able to get out of this loan. And we got to be, up for keeping on our books for a while, which we're comfortable with.
All right, everybody, that is the pod for today. If you've been watching or listening to the Private Lenders podcast, first of all, we appreciate it. If you've been checking it out for a while, we really, really appreciate you. Keep an eye on our content. This is why we do this. If you're considering taking the next step in coming to one of our live events, go to hardmoneymastermind.com, click on live events, schedule a time to talk to our team, and we hope to work with you in person this year. Have a good one.
Thank you for joining us on this Private Lenders podcast episode. Please note that opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, financial, and accounting professionals. If you enjoyed this episode of the Private Lenders podcast, we would appreciate it if you could spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for all private and hard money lenders.